Well, in fact, our next guest had a calculation for how much the taxes would actually pay, the Warren tax would pay for the actual proposals from certain segments. I think it's like one. Let's ask him. Let's bring in our guest, David Gamage, Indiana University law professor, informally advised the Warren presidential campaign on a wealth tax, and Joel Griffith, research fellow for the Institute for Economic Freedom and Opportunity at the Heritage Foundation. I think that was your number, wasn't it, Joel? The Warren taxes pay for 1/25th of it, but at least we only got 24/25ths to go for what we really need to do.
And she has a plan for that too. In fact, if you add up all the proposals, taxing those that make more than $150,000 per year, the payroll taxes, all of that, it still does not come close to paying for this bill. But on this wealth tax, what we know, the bottom line is that, number one, it's unconstitutional. But even if it were, it's economically destructive. People forget that capital is what makes us more productive. It makes every worker able to produce more. It helps all of us live more prosperous lives. When you talk about a wealth tax, it's not just, as Elizabeth Warren likes to say, going after yachts and diamonds and Rembrandts. No, the vast majority of wealth in this country is actually invested in profitable, productive business enterprises. Go after that wealth, and guess what? All of our standard of livings decline.
David, that's a point that Joel makes again and again, that it's not buried in a mattress or sitting in a vault somewhere, that it's being deployed in American companies, in America, in entrepreneurship and everything else. Do you disagree with that?
I agree that revenues and assets and wealth of the super rich and everyone else is profitably invested. I totally disagree that a moderate tax on capital or on assets has bad economic effects. History suggests quite the opposite. The U.S. economy did far better decades ago when we had much higher tax rates on capital. And in fact, the lack of tax at the high end is, in my view, damaging the economy. I see all the time very complicated, economically damaging tax gaming, tax avoidance stratagems that waste resources in order to conceal them from our existing tax system. Patching our existing tax system to bring it back to levels that would meaningfully tax the super rich and combat some of these tax avoidance games, in my view, would bring the economy back to a better functioning level. Plus, there's the issue of declining government investments in all sorts of activities that have historically been shown to be economically beneficial. And again, I think, yes, the fact that assets and wealth are invested profitably is true, but that doesn't mean that a moderate tax in a way that patches holes in the existing tax system would hurt the economy. In my view, it would help the economy.
But David, there's a recent paper out that talks about basically how much wealth the wealthy have, and more importantly, where it's invested. And it looks like a greater share than we expected is in private companies. When you look at the difficulty of valuing private companies, you look at goodwill, you look at a private business, how do you actually, you're going to have tens of thousands of IRS auditors auditing probably hundreds of thousands of wealthy taxpayers to get that revenue. Does that make sense?
So let's be clear, a good portion of the reason why so much of the asset base at the high end is invested in private companies is based on current tax avoidance stratagems. And many of these investments are done in a way that are economically damaging. We see this for estate tax avoidance, where super rich pool their resources in a way that's well known to be inefficient, economically damaging in order to reduce valuations. Now, there's known ways to combat these stratagems that would be built into a wealth tax, and honestly should have been built into the estate and gift tax a long time ago. There are formulaic measures for assessing the value approximately of private held companies, along with limited use of assessment. And yes, IRS resources should be brought up considerably.
Yeah, the fact is, the professor says the economy has gone down relative to how it was 40 years ago. That's not the fact. The fact is, the median family income's at all-time highs. The middle class is shrinking. That's because people are moving from the middle class to the upper middle class and upper class. This is census data. For him to say that the economy for those that are the typical income earners is actually less, that's just factually untrue.
All right. Okay.
Productivity growth and median wage growth is dramatically lower than it was in the 1950s and 1960s.
Census Bureau data, sir.
The debate continues, gentlemen. We appreciate it.